The markets are closed for the weekend, but the story that unfolded in Cambium Networks, ticker CMBM, is still echoing across trading desks. We ended the session on Friday, October 31st, at a closing price of $2.99. This was after a brutal, catastrophic intraday collapse of over 20%, shedding 76 cents on the day. But that closing price, as shocking as it is, does not even begin to tell the real story. This is a stock that on the very same day printed a high of $6.80. Let that sink in. A stock opened, more than doubled to hit its 52-week high, and then proceeded to crash all the way back down, closing near its low of $2.82. The volume on this move was astronomical, with over 20 million shares changing hands, a massive surge compared to its usual average. This is not a chart pattern, this is a battlefield. And what's truly remarkable is that this entire event, this parabolic surge and subsequent implosion, was the culmination of a war between a speculative headline and a terrifying fundamental reality. The expectation for Cambium for months has been terminal. This was a company flirting with irrelevance, a stock that had traded down to a 52-week low of just 23 cents. The market narrative was one of impending doom. The company had received a delisting notice from Nasdaq for failing to maintain its minimum bid price, and perhaps more critically, for failing to file its required annual and quarterly reports on time. This is often a final death knell. The financials supported the scrim outlook. But then, the unexpected happened. Just a few days ago, on October 29th, news dropped that Cambium was integrating its One Network platform with Starlink. This was the match that lit the fuse. Suddenly, a company on the verge of delisting was associated with one of the biggest names in next-generation connectivity. The retail crowd, as seen in heavy discussions online, piled in, seeing a path from 23 cents back to respectability powered by a high-profile partnership. The stock exploded, hitting a high of $7.25 just 2 days ago, and then $6.80 on Friday, in a move that seemed to defy all fundamental logic. But reality, as it so often does, has a habit of reasserting itself. The spike to $6.80 was not a reassessment of value. It was a violent, textbook short squeeze. And when the squeeze broke, the fundamental gravity of the situation took over and pulled the stock straight back to earth. The crash from $6.80 to $2.99 in a single session was the market remembering exactly what this company is. And what it is a company in deep, deep trouble. The Starlink news, while positive, does not fix the underlying rot. We're looking at a company with severe covenant compliance issues on its debt. It has $68 million in debt that is now classified as short-term, meaning it's due soon. To meet this, the company only has $46 million in cash. This is not a sustainable ratio. It's a liquidity crisis in plain sight. Revenue has been in decline, falling nearly 20% over the last few years, and the company is bleeding with a trailing 12-month net income of negative $98 million and a terrifying negative profit margin of nearly 57%. This is where we must talk about the short sellers. This was not a random event. It was a calculated war. The short thesis on Cambium is not a mystery. It is an open book based on the financials I just mentioned. The short interest in CMBM coming into this event was incredibly high, standing at 1.59 million shares. That translates to a massive 12.55% of the entire public float being sold short. This is an enormous bet against the company. But the most critical metric, the one that explains the violence of the spike, is the days to cover. Cambium had a short interest ratio of 13.18 days. This is an eternity. It means that, based on average volume, it would take shorts over 13 full trading days to buy back all their borrowed shares. So when the Starlink news hit, it triggered a panic. Shorts ran for the exits, but the door was tiny. The availability of shares to borrow to create new short positions dropped to 0 on October 29th. The squeeze was on. The longs, fueled by the news, and the shorts, forced to buy back at any price, created the parabolic move to over $7. What's your take on the Starlink integration? Is this a genuine lifeline for Cambium, or was it just hype for a short squeeze? Comment below with your thoughts on this. For investors trying to navigate this, it is crucial to understand how to track this information. You can find short interest data on most major financial platforms, usually updated twice a month. This data, published by Nasdaq, will show you the total number of shares sold short. You then compare this to the public float and the average daily volume to get the short percent of float and the days to cover, respectively. A high percentage of float short, especially over 10%, signals high conviction from bears. A high days to cover, anything over 5 and especially over 10, signals significant squeeze risk. You should also look at the borrow fee rate, which is the interest rate shorts must pay to borrow the stock. While Cambium's rate was not astronomical, the availability dropping to 0 was the key signal. Another metric to watch is the failure to deliver, or FTD data, which is published by the SEC. Cambium's FTD data from recent months showed multiple days with tens of thousands and in some cases over 150,000 shares failing to be delivered, a sign of settlement stress in the stock. The institutional filings paint an even clearer picture of this war. The smart money was deeply divided, but the bears were dominant. In the most recent filing period, major institutions ran for the exits. Topline Capital Management sold its entire position of 1.4 million shares. Citadel Advisors, one of the largest players in the market, also sold 100% of its position. The Vanguard Group dumped over 70% of its holdings, and BlackRock sold off a significant chunk as well. This was a mass exodus. They were clearly aligned with the short thesis. The company is fundamentally broken. However, on the other side of the trade, you had firms like 2 Sigma Investments and 2 Sigma Advisors, which added over 500,000 shares combined. This is a classic conflict: fundamental sellers versus quantitative or event-driven buyers. The sellers, however, were far larger, and their thesis is the one that won out on Friday. The risk of chasing a short squeeze is that you are buying into a fundamentally flawed business, and as we saw, the squeeze can break just as quickly as it forms, leaving those who bought at the top holding a heavy bag. So what is the business that is at the center of the storm? Cambium Networks provides wireless networking infrastructure. Its One Network platform is designed to unify various wireless technologies, like fixed wireless broadband, outdoor Wi-Fi, and indoor enterprise Wi-Fi and switching, under a single cloud-based management system. The idea is to simplify network operations for their customers, which are typically internet service providers, government entities, and other large-scale enterprises. They operate in a highly competitive space, going up against giants in the communication equipment sector. The Starlink integration was so exciting because it promised to connect Cambium's last-mile wireless equipment to Starlink's satellite backbone, a potentially powerful combination for deploying internet in remote or hard-to-reach areas. Looking ahead, the future for Cambium is balanced on a knife's edge. The expectation of doom has been challenged, but the reality of its financials remains. There are 2 distinct paths. The bull case, which is a very narrow path, rests entirely on this Starlink partnership and a potential turnaround from new Wi-Fi 7 products. If the company can successfully leverage this partnership into tangible, significant revenue, and if it can convince Nasdaq at its upcoming hearing that it has a viable plan to regain compliance, it could survive. The analyst targets, which are now scrambling to update, are clustered around the $3 mark, suggesting they see no immediate upside from here. The bear case, which is the path of least resistance, is far more likely. The company is facing a Nasdaq delisting. It is facing a debt crisis, with $68 million in short-term obligations and only $46 million in cash. This is not a sustainable ratio. It's a liquidity crisis in plain sight. Revenue has been in decline, falling nearly 20% over the last few years, and the company is bleeding with a trailing 12-month net income of negative $98 million and a terrifying negative profit margin of nearly 57%. Looking at the 13-day to cover ratio, do you think the shorts who held on are trapped, or are they right about the company's bleak financials? Let me know what you think in the comments. As we head into next week, the key signals to watch will be any SEC filings from the company regarding its plan for NASDAQ compliance or any financing announcements to address its debt. The short interest data will be updated soon, and it will be fascinating to see how many shorts were flushed out by the squeeze and how many new ones piled in at the $6 and $7 levels. The expectation was that Cambium was finished. The reality of the Starlink news created a temporary, violent surge that looked like a resurrection. But the final reality, the one that brought the stock crashing back to $2.99, is that the company's fundamental problems are severe, and the institutional owners have voted with their feet. The battle is over for now, and the bears have, for the moment, won a decisive victory.